So we use different types of budgets to control operations. We've talked about a master budget last time. And so this master budget is, we talked about the sales budget that flows through, and eventually we have our production budget, which goes into our pro forma financial statements. But there's some alternative approaches to having this giant master budget. We can have fixed budgets or flexible budgets. The fixed budget is also known as a static budget. And so circle fixed budget, highlight it, take it in your notes. And I would always associate fixed budget with static, right? Fixed budget is static. And when I'm saying it's static, it's an alternative to the master budget. Master budget previous chapter, now we're talking about our alternative approaches, fixed, which is static, and flexible, which is variable. Make sure that we have those associations. So if I ask you, is a master budget a fixed budget? Say, no, a fixed budget is an alternative to the master budget. It's a static budget based on a single predictable measurement. And our flexible budget, is that a master budget? No, our flexible budget is a variable budget. That's an alternative approach to the master budgeting process. Right, so make sure you understand, and that's where you'll be taking your notes, and where I suggest you taking them through your Google Docs. So our master budget is always on a predicted level of activity, but our fixed budget is based on a single predicted amount of sales or other activity measures, while our variable budget is going to be what if those measures change. This flexible variable budget is more practical. If we think about it, if we have a business, we might estimate that we make $1,000 in sales a month, but that estimate is a future target. So we could either say 1,000, we could say 1,000 sales a month, or we could say we might hit 2,000, or we might hit 3,000. And what would those different scenarios look like? That's what we're talking about, this flexible budget. We want to offer ourselves some flexibility. And we can use a fixed budget and flexible budget process as alternatives to preparing a master budget as well. So we can make these as standalone alternative approaches to budgeting, or we can build this into a master budget and have a master budget that's flexible or fixed. So there's all these variations. It's all up to your decision on what works best for your business, or up to your boss's decision. So here's a good example of a fixed budget performance report. So it's based on a single predicted amount of sales. So we have a fixed budget. We're saying at this company, we're gonna have $100,000 in sales. If we have $100,000 in sales, we expect to have this much direct materials, direct labor, overhead, selling expenses, and G&A expense, and this is our expected income. And so we might say that's our expected for the year, or this is our expected specifically for the month ended January 31st, 2019. So we're saying just this is for 1 month. And then at the end of the month, you'll go back and compare your actual results and say if they're favorable or unfavorable. Relatively simple. I'm not going to ask you to determine the fixed budget here or the actual results. I'll ask you to do the comparison and tell me if it's favorable or unfavorable. So we'll go through this really quick. It takes just more of a common sense approach. You can also memorize it, but it's more of a common sense approach, right? Where if our actual results are 125,000, but we budgeted 100,000 in sales, we have a favorable variance, right? We made more money. If our cost of goods sold is higher than our fixed budget, we spent more money, so it's unfavorable, right? Here we spent $3,000 more on materials, $5,000 more on labor, etc., all unfavorable. Our selling expenses are unfavorable if we spent more than we planned, and our G&A expenses are unfavorable if we spent more than we planned. Now, this here shows us the problem with fixed budgeting, because if I'm a manager and I look at this just from a fixed budget perspective, I'll say, great, we hit all our sales, so I'll reward my sales team, and then I might punish my cost team, right? I might complain and say, well, hey, we missed our budget for costs. What happened here? Did you spend too much on materials? Did you not negotiate correctly? Did you waste the materials? Did you eat hours? Did you use too many hours? In reality, from just a common sense approach, if we have more sales, it's probably going to cost us more to make those sales. So it makes sense that we have more expenses associated with it. And so this is the flaw of the fixed budget. The flaw is if we have more sales, or if we overshoot one of our targets, generally the rest of our targets are explained very well through that overshot of sales. And so that's where we will try to have a flexible budget that will show the activity we expect if we hit these different buckets. So in a flexible budget, we would have all projected for a bucket of 100,000, 125,000, 150,000, or so on and so forth. So we show revenues and expenses that have occurred at the actual level of activity. And so it's what we also call a what if analysis, so we can have an apples to apples comparison. So what if we made 150,000 in sales? What if we made a 200,000 in sales? And this provides better evaluations for managers to focus on problem areas. And so anytime we go to assess an underlying issue from a management perspective, there's always more than meets the eye. As a professional accountant, if I'm managing a team of accountants, and let's say they're taking, I find out that one of the jobs that they're working on, I advise a consulting firm, and I go and help with them with project management sometimes. And I will look at some of their projects and they'll say, hey, we keep getting over budget. We keep spending too much on this project. As a manager, I could say, wow, well, your employees must be working too much. Is that the case? Are your employees working too much? Are they not efficient? Are they not actually working and they're billing hours that they shouldn't be working? There's a lot of underlying problems that when you're budgeting, you could say the budget might be wrong. There's all these issues you can identify just by seeing someone going over budget. But then if we find out that actually they're getting a lot more work and the budget was just a fixed budget, maybe these employees are doing a great job, right? So we have to really understand what is the purpose of the budget. The budget is to help us manage. And so we have to let the budget work for us. We can't let it just be some kind of fixed number. So let's prepare a flexible budget and then interpret it. So to flex a budget for different activities, that's all we're talking about. So we'll have variable costs that change in direct proportion to changes in activities. Remember, we talked about variable costs and fixed costs. What are example of variable costs? Example of variable costs are costs that change with units of activity, like hours of work, number of units produced. Our fixed costs are like our monthly rent, right? Our lease cost, our our salaries, the salaried employees. So we'll prepare a flexible budget. That flexible budget is flexed on our variable costs because our fixed costs don't change within that relevant range. Make sure we're taking notes at how this all ties back in, right? We've talked about variable costs, what define those. That's what we tested about last. Now we're going to be talking about how we use those to create flexible budgets. So this should look familiar to you, right? This looks almost like preparing a contribution margin report, right? A statement of contribution margin instead of a statement of income. Separate our variable costs from our fixed costs, but now we're using it from a budget perspective. I was just on a job that I was working on where you'd be surprised. It's used at my companies. It's used everywhere. I saw the words contribution margin. I saw contribution margin report, and I was thinking, wow, I just taught this to my students. They could go and help with something like this, right? So this is very relevant to your education. So variable costs are a constant amount per unit, right? So we talked about the patterns of variable costs versus fixed costs. Variable costs increase at a linear amount. Fixed costs don't change for the amount per unit. We've talked about those behaviors. But what we do here is now we say flexible budget of units per the sales. So this is just another way of us applying that information of fixed and variable costs. So our variable costs here we're saying direct materials is $1 per unit. That's 10,000, 12,000, 14,000, right? We're saying $1 at 10,000 of sales, 12,000 of sales, 14,000 of sales. And we'd figure out these costs per unit, which we could have done in our master budget process. We know that our sales per unit, and we know our contribution margin per unit. And then we'll split out our fixed costs. And we see as the units go up, our fixed costs don't change. They will always remain the same. And that's what drives this increase in contribution margin, is what drives our increase in income from operations, right? Because the fixed costs don't change. And so using the same scenario, I think this is very similar to the scenario above, we can determine if we are still within our variances, right? And so we're going to look at what if we use a flexible budget rather than we use the fixed budget from what we talked about at the beginning. And so let me pull that up here. I think that'd be useful for you to compare. So we'll jump back for it. This is our fixed budget, same company. Fixed budget, variable budget. Fixed budget, we would have knocked all of the cost departments, the selling departments, all of these for them spending too much money, even though our sales increased. The flexible budget, we can really dive more into what the issues are. And we'll be able to identify if unfavorable is because the total variable costs and total fixed cost variances because the actual costs are greater than what we expected, and favorable if our income is greater than expected or our costs are less than expected. So for notes, unfavorable, if income is less than expected or costs are greater than is expected, which is common sense. Favorable, if income is greater than expected or costs are less than is expected. And so we can go line by line here. Our sales are up $5,000. And so in business, we'd have a note over here saying, why was it up by $5,000? It's up by $5,000 because we didn't sell more units. We must have sold more, sold them for more dollar per unit. So that's a favorable variance because the sales team was able to sell them for more. So that sounds good to me. Direct materials is unfavorable by 1,000. And so we would have to ask the team what happened here. And we have a better indicator that they probably shouldn't have been so far off because we're using a flexible budget. Same with the direct labor. You can ask them, hey, how did we go over here? Was our labor inefficient? Was someone sick? What's going on? How can we fix the problem? Ultimate goal here is process improvement, so we can dive in and fix the problem. Factory supplies was favorable, so we used less factory supplies. We'd want to understand, did we do anything? Who was responsible for the supplies? How did we wind up in this advantageous position? Same things, utilities were more expensive. Why did we use more utilities? Sales commissions netted to zero. And this is not favorable or unfavorable, but then we should ask ourselves, hey, should maybe have paid more sales commissions or give them some kind of bonus for being able to sell them for a higher dollar value. Shipping expense was favorable. So whoever negotiated the shipping and office supplies and factory supplies, so it seems like our office manager is doing a very good job, but maybe this is how I'd interpret a report like this, but maybe our direct machining staff or the people building the units aren't doing so well. So the foreman we would need to go talk to. And then from a fixed cost perspective, our insurance went up. And so we'd want to go investigate and see if we can renegotiate our insurance expense. This is how gives us a much more complex and in-depth understanding of budgeting than if we use just a fixed budget report. A fixed budget report, we just say, wow, all the people managing costs are not doing so well. But when we dive into it, so, well, our office manager seems to be doing a great job. Our sales team seems to be doing a great job. And actually, we should probably pay them a little more commission. Well, here we say we paid them too much commission in the previous report. And then we know that some of it's being driven by insurance expense. And then any unfavorable outcome is really coming from our direct labor and their use of material. So we will need to investigate that further. So that's really flexible budgeting versus static budgeting. I'll keep going and I'll pause for questions about halfway through the lecture, and I'll look through the notes as well.